Can I get your responses, please? Okay. If there is no question or anything, then I will just move on to the next topic in the class. Okay. So, in the other part of the okay. So, in the other part of the analytics that we normally want to do for the investment is to understand the profitability of the company. So to understand the profitability, that is also a very much useful technique for any kind of analysis. We can do that. Let's look at also the horizontal and vertical analysis, because I think I don't have a specific slide for this. So let's say if you are going to do the horizontal analysis for the Walmart, right? Horizontal analysis basically means you are going to compare this year performance against the previous years. So when we want to compare the performance of the Walmart against the previous years, we need to compare the performance of like this year versus the previous year. So that's the in absolute terms. So horizontal analysis can be done in both the ways. Look at the horizontal. So from 2019 we cannot, because we don't have the data of 2019, but 2023 we can. So we can see what is the variance over a period of last year, right? So toward the 2023 will show a variance of 38,000, means the revenue has been more by 38,000. In 2022, revenue was increased by 13,000. 2021 revenue increased by 35,000. 2020 revenue increased by around $10,000. This does not make any good impression or any good information on us. Why? Because it's a absolute information. It's an absolute term. It's very hard to understand any context out of this. So normally, what we do is we calculate the ratio, and to calculate the ratio we divide the number by the base number. So in 2000, for 2022 23 it will be 2022. So now we will get a percentage, how much percentage has increased, and that will be more relevant for us to understand the overall picture of what has been the growth in the last year, right? So horizontal analysis and trend analysis normally is done in conjunction. So we can see the Walmart's performance 2023 is increased compared to 2022, 2021, 2020 by 1.9%, 6.7%, 2.4%, 6.7%. And it's a trend also. So, right, what is the trend here? The trend is now even in 1 month is increased very much, and the 2022 it drops, but the key trend here is that it's increasing in terms, right? It used to be 2%, then 2.4%, and now about 6.7%. So that's the trend that we can see. Okay, now the sales is increasing. What about the cost of goods sold? The cost of goods sold is also increasing in terms of 2.4%, 6.5%, 2.1%, and 8.1%. So we can say that, okay, this year in 2023, the sales have increased by 6.7%, but the cost of goods sold has increased by 8.1%, which means that our profit, our gross income would be reduced, right? It instead of say 3.5%, it's just only around 2.7%, which is lower. We can do the same for the sales and marketing expenses, and then earning before interest and taxes. So now we can see that earning before interest taxes has in fact reduced, has dropped. Why? Because selling and general expenses have outgrown or increased more than uh, the other months, other years, right? So it's a significant increase compared to the previous year. So we can say, why is it? Now, in the public information, that's the only information we have available. Still, selling general and administration expenses have increased by 6.7%. So if you are an executive or you are a shareholder, you may want to understand whether it's a one-time cost increase or it's going to be continuous. In the past, historically, the revenue, the sales, these expenses were 0.7%, 3.7, 3.1, but in this particular year, 6.7. So it could be a permanent change in the business model, or it could be a one-off incident in 2023, which is can happen. If it's a one-time investment, one-time incident, you have to ignore it, right? Or if it's a regular scenario, then you have to probably take care of it as a permanent change in the business structure. So whatever is the case, you might want to go back into the details if you are available, and establish the reason why is that happening, and then make your decisions accordingly. So this is horizontal analysis and vertical analysis. Now, this information is still not very complete because it does not tell us relatively the performance seems to be bad, right? But because the sizes are different, so even if the cost has increased significantly, what it is in terms of percentage to sales, whether it's a bad thing or good thing, or if bad, how bad. For that, we normally carry out another type of analysis, which is called vertical analysis. So vertical analysis usually assume that the sales is the base number, right? So we take the largest number on the financial statement. For profit and loss, it's the sales, total sales usually, and for the balance sheet, it's total number of assets. So that's the largest number on the balance sheet, right? So normally we take this as a base and we calculate every other number as a percentage to sales. So how we do that? We calculate the sales, the cost of goods sold divide by the sale. So that's how we are going to calculate it. Sales divided by sales we normally don't do, but you can do that as well, just for the sake of filling up the information here. So we can do this as well. And then we can calculate it just only few rows first, because that does not make any sense. Okay, so now we calculated the information. So you can see now that the when we look at a vertical analysis, the cost of goods sold is has increased from 74.9% to 75.9%. So it's 1% increase in the cost of goods sold as a percentage to revenue. So if you see here, it's not 1%, it's 1.4%, right? Difference. But in actual, the cost has increased by 1%. It could be a difference because of supply chain pressure, or it could be another reason that the company knows better. So you may want to ask company, right? The expenses, selling and general expenses has been around 20.1% and 20.1% and 20%. So even though in the horizontal analysis, we saw that the selling and general and administration expenses has grown 6.7%, while the other the profitability has not increased that much, and that has created a drop in revenue compared to the last year. But that may not be the true fact. When we look at the ratio to sales, total revenue, we just look at is 20.1% and 20.1% is the same. Compared to sales is the same amount, but compared to, hello, is everybody back? Okay. compared to the total sales is not that significant. There is no increase, right? So it may not be very prudent to target the selling general and administrative expenses and put the blame on them to to make the company drop the profitability. So it's the culprit is different. The culprit is really the total number of cost of goods sold, which is increased by 1%, and that has created a different pressure on the earning before interest and taxes. So this kind of analysis also can be done via GPT. So you can copy this and give it to the ChatGPT and ask it, please carry out a vertical analysis and horizontal analysis for Walmart in table format. You can ask ChatGPT to also calculate it. It can calculate it. You can see it's pretty fast in calculating that vertical analysis and horizontal analysis. You can copy this and paste into the Excel to get the results. So, but the result will be the similar one, right? So it's not going to be different. So this is how we can do the vertical analysis and horizontal analysis using the Excel and also using the ChatGPT, using the AI tools. Okay, moving on. Now let's look at the ratio analysis. So some of the profitability ratio analysis that we can use for understanding the performance of the company is gross margin ratio. Now, gross margin ratio calculates the percentage of revenue that remains after deducting cost of goods sold. So in our case, in our Walmart case, the gross margin here is 611 minus 463 cost of goods sold. So that's the gross income 147,568. Now we can calculate a percentage easily, right? 147 divided by 611 is going to be about 24.1%. So that's the gross profit margin. Then you have operating profit margin. Operating margin usually comes after deducting the selling and general expenses. So other operating expense, which is means if we want to treat this earning before interest and taxes as gross profit, we can also consider this as a operating margin, and we can use this as a percentage for now, right? uh, Net profit ratio, this is after we calculate everything, operating expense, depreciation, interest, everything. So here is here is the pre-tax information, uh, or the income tax. After income tax, everything is 11,000, 13,000, and this kind of information is there. So that's how we can calculate it. And there are some expense control ratios, like for example, sales and research and development expenses, cost of goods sold, sales expenses, administrative expenses to revenue, to understand whether how the expenses of the company are contributing to the are or affecting to the profitability of the company as overall. So there are certain things that we have to remember when you are calculating the ratio analysis is that ratios are useful when you can compare them to something. So for example, now if you calculate the profitability ratio of Walmart is for 1 year only, let's say for this year only, 2023, the gross income is here 147 divided by 611 is 24%. Now, what do you understand by this number? You have no reference to know whether this 24% is a good number or a bad number. There's no comparison with last year, no comparison with the other things. So it will make more sense if you compare this against the previous years, let's say the previous year was 24.7, 24.8, 25.1. This year is 24.1%. This clearly indicates that there is some problem, right? Because the profitability ratio, the gross profit ratio, has dropped over a period of last 4 years. Now, when you compare this against let's say against the uh, target, it's even more clearer, right? So let's say we want to calculate that, and then we want to understand the gross profit margin of. So the gross profit margin is 24% for target, 22.6%, and over the last previous year it was 27%, 27%, 26%, 26%. So even though when you are comparing in the previous years, the target was having a better profitability compared to Walmart. Now Walmart has a better occupancy, better profitability. So Target's profit has dropped by 5 percentage points from 27 to 22, while Walmart was able to maintain it by reducing only 1%, right? So it's the way you want to tell the story. So let's say if you want to tell the story that Walmart has been doing very bad, you just compare against the last 4 years and show the drop in the profitability, correct? So you can communicate that story that Walmart's profitability is not good. But if you compare, if you want to show that yes, even though we are dropped, we are still the heroes, you can compare against Target and show that oh, Target has dropped their profitability by 5%, means they were not able to control because of the market situations, and Walmart was able to regain or retain their profitability to a decent level in and by losing only 1 percentage point compared to the Target. So there is the two perspective, both perspectives are right, and both perspectives are wrong at the same time because they are not complete. If you isolate them, you get a different story altogether, but if you combine them, you will get a whole picture. So that's the idea of the ratio analysis. They are more useful when you compare over a period of time, compare against the industries, compare against the companies, and you can not rely 100% on the data, right? So let's say the accounting has been messed up in Walmart, and the inventory is overflow or overvalue. In the closing inventory is overvalued. So their cost of goods sold is not correct. And if cost of goods sold is not correct, your profitability ratio is also not correct. So the ratios are complete and accurate only until the data is accurate. So it depends on whether you're getting accurate financial statements or not. So you have to be careful in relying on the numbers blindly. And ratios give a snapshot at a particular time. They don't know about the external factors. They don't know about non-financial aspects, and they are just only a diagnosis of problem. So even if you know that hey, the cost of goods sold is dropped by 1 percentage points, it does not tell you why. It does not tell you where. It does not tell you what to do. It just gives you some indication that yes, there can be anything. It could be a price drop. It could be a supply chain extra cost which was not able to be passed, whether it was supposed to be passed or not, whether the company made a conscious decision to not to pass it on. uh, this kind of information is not available in the analytics at the moment, right? So you have to get the more detailed information about the incident before jumping onto the solutions. uh, and then the qualitative factors are not available. So as I explained earlier, there is a very there are a lot of aspects to the profitability ratio that we just discussed. The management quality, whether the company wanted to, or the vision of the company, whether they wanted to pass on all the cost to the suppliers or to the customers, or they were able to negotiate with the vendors, or they were not able to negotiate, or they were they were not able to manage, they were able to better manage the productivity or the employee cost compared to target. Whatever has been the reason, we have to look at those qualitative aspects as well before making judgments or before making decisions only based on the financial ratio numbers. Okay. This we have already covered in the previous hour. Now, next analytical steps that we normally have to take. So this is only one part of the financial statement analysis, primarily looking at ROE. I explained you about the DuPont analysis to understand the return on equity, return on investment. I explained you about the profitability ratio of the companies, how we analyze them for investment purposes. Now there were other method that we explained that we wanted to discuss was also the discounted cash flow, but that's not the part of this particular class, because discounted cash flow is a different, altogether a different topic, or valuation is a different topic, right? But the most important part in the investment analysis is to understand whether the returns are there or not and compare them against the benchmarks. So that process I have already shared with you. Right. You can also use AI to help in making the case for the judgment. So let's say you want to use the free version, you can use Bing because ChatGPT 3.5 does not have internet access, so it will not be able to give you the right answer. But Bing has more information. So Bing give you the information, so you can say, uh, act like a finance expert and advise me on potential investment into Walmart, right? Compare against target, give me DuPont analysis, PE ratios, strengths, and weakness in each company of companies, other factor which may impact the decision. So you can ask AI to help, but you need to know and ask them the right question. Because, oops, okay, it is giving you the answer. So because the you need to ask it what exactly you want to do. Otherwise, it may give you very vague answers. It can continue to do it. You can try that out. The most important part here is going to be the prompt that you ask it, because that will define the quality of input output as well. So you can experiment until you get a very good answer for on your own, right? There are some plugins which are paid plugins you can use as well to do the analytical part. So in the plugin, you can search what kind of plugins are available for financial statements. There is one called Wolfram. You can search here, plugin store, and then you can create Wolfram. It access the competition and real-time data through the language. So it's most on competition information. This is stock market. I don't know if there is anything stock market related or not. Is there Bulio invest analyze stock investment from any country with Bulio state of art engine? So you can try that out, or you can try another one AI ticker chat as well. So it will retrieve the USA stock insights. So you can use multiple there. There are multiple one of them. You can try and play around which suits your best requirement. Okay, so the next application for the financial analysis was the due diligence by bank for loan processing. So for that, they need to look at the cash flow investment. Cash flow is if you can see cash flow statement for Walmart. I didn't download it, the data, but and check it out. The cash flow statements usually are a combination of a statement which gives the three different activities. List out the three activities. Never mind, I have the information. So let's say that we want to give a loan to Samsung, right? So what we would do in that case is we would read the cash flow statement for Samsung analysis and the invest cash flow investment. Here is the investment cash flow of the Samsung. So what it does is cash flow is divided into three parts: operating activities, investment activities, and also the financing activities. So the banks usually would look at would look at the cash flow statement to understand how the company has been generating cash and how it has been spending the cash. So the difference in compared to looking at the profit and loss statement and the cash flow is that let's say we look at the only cash flow statement, only the income statement, right? So based on the income statement, the Samsung has generated around how much? Here, Samsung has generated a total profit of 55 million, or let's say here in dollars, in 2022, $43 billion in terms of profit for the year. You can assume that this was the cash generated as well, but it's not really the cash generated by the company. Plus, this does not tell us where the company has invested the money. We might have to look at the balance sheet and say, okay, where the money of this $43 million has gone. Uh, Ideally, this 43 million should have been in cash, right? But it's not. There is some investment into the inventories, some investment into the property, plant, and equipments, but it does not give a one-page view. So the cash flow statement helps to understand where the money has earned and where it has gone. So here it will start from the profit for the year, let's say $43 million, and then it will show uh, some adjustments. Like adjustments would be the assets and how much is the asset and liabilities has been changed, and or other what kind of adjustments are there, plus the interest received, income tax paid, all will be adjusted from here. So it will calculate net cash from the operating activities. Now, what is the net cash from operating activities? Is $48 million. So even though the profit of the company shows 43, actually company has earned 48 million dollars from 2022. 2021, their profit was only 30 million, but the cash flow from operating activities was about 50 billion, right? So that was the difference. Now, in the how where the money has gone, because it's not shown in the cash, right? So the company, you can see investment activities. Out of this 48 billion, the company has invested for 24 billion in the investments. So investments has gone into the acquisition of the new properties. They sold some, right? They sold some investments in financial investments, sold some of the long-term financial statement, the long-term financial instruments, and purchased long-term property, plant, and equipments, $38 billion. $36 billion last year. So in total, in both the years, they invested around $25 billion into new acquisitions. And also they decreased the net term borrowings. Plus they paid some dividend, 15 billion and 7 billion. So totally they pay 15 billion each year in terms of dividends and in terms of borrowing reduction. So mean they reduce their loan, the debt. The net amount that increase in their cash was about $7 billion in each year. So the cash flow was originally before that was 22. At the beginning of 2021, it increased to 30. From 30, it increased to 38. So now it has $38 billion. Next year, if the company is earning, let's say 2023, company is not earning much, they can use this money to either purchase their more assets or reduce the debt. Now, from this statement, you will say, hey, the statement looks pretty healthy, right? They are earning quite a lot of money from the operating income. The company has been investing into the new property, plant, and equipments, which means that company has plans for future expansion or future development. So the sustainability of the cash is going to be continued, right? And also they are reducing their debt plus paying off the equity. So even if we invest now or even if we give them the loan, we are sure or we have a reasonable guarantee that the money will be returned back to us. So this way the banks will try to look at the cash flow to understand what is happening in the company in terms of cash flow, in terms of cash. This information is not directly available from the balance sheet and profit and loss, even though this information is coming from there, but it's not directly available. So you have to read in details and understand the differences from each line, and then you will be able to estimate this thing. And not all the numbers are available in the face of the balance sheet because many of them are hidden. Many of them are not really shown consolidated with other numbers. So you will not get an exact idea of what is happening in the cash flow. So that's the cash flow statement of the Samsung. That's how the banks understand the health of the cash flow statement, right? Then they will look at the credit history. Now, this credit history is their evaluate past repayment behavior. They may ask the company to submit the bank statements, and they will check whether the company has been paying their debt in the past or not. And then they will look at the debt service coverage ratio. Now, what is this? Debt service coverage ratio. Debt service coverage ratio is that whatever is the operating income of the company, right? Divide by the existing debt services. So it means the debt services means the repayment of principal and repayment of interest. Whether the company's income at the moment, operating income, is enough to pay off the principal, to pay off the interest that the company need to pay and or not, right? Plus the investments, plus the if there is an installment based, then they will be able to pay their installment or not. So that's a very important decision that the bank has to take. If let's say there's a principal involved, you can add the assets value to the component and say even if you are able to cover the interest portion, the principal portion can be covered by the assets. So you may not need to worry about if the operating income is not enough to cover the whole principal repayment, right? Plus, it will also look at the credit score by another borrower, another agency who may look at the credit worthiness of the company. So this is the pitfall. This is the summary of the banks, how we use it. The next part, another part of that the company that the bank may look at is their liquidity ratio or the risk as described in the balance sheet, right? So you can check whether the company's what is the company's liquidity and risk ratios. There are formulas. We can check the formulas, current ratios, we can normally calculate it by cash plus inventory plus receivables divided by the current assets. So that helps to understand whether the company will be able to meet their short-term liabilities because it's a current ratio, right? And we are basing the formula on the current liabilities. So if the current ratio is less than 1 or less than 2, means the total assets, cash, inventory, receivables should be twice as much of the current liabilities. If it's less than that, the company will be deemed as risky. Risky means risky to enable their short-term ratios. If it's less than one, it's very risky, like high risk, because that means that in case anything go wrong and the company supplier want to come and collect the money from the company, they will not have enough money in the short term to fulfill their needs, right? So anything above one is good. Anything an ideal number is two. If anything below one is not really a good number. Then there is a quick ratio. The quick ratio basically is we remove the inventory because inventory may take time to sell. So we remove that so that we know whether the company will be quickly able to sell, let's say in a period of 2 months or 3 months only. But then that may not be enough. So because the receivables also may be difficult to collect. So that's why we call another formula called asset cash ratio, which just means immediate, right? Anything now is in fact because we have the cash in our hands. So that's the is calculated by cash and cash equivalent divided by the current liabilities. So we can use the AI help to check whether we can calculate or not. Let's say we can give it, please calculate liquidity and risk ratios for both the companies. So it can calculate risk ratios. So it can calculate, you see, for ratio, quick ratio, and debt to equity ratio, interest coverage ratio. That's called debt service ratio. It can calculate everything. 2023, 8.12%. For debt to equity ratio is 1.8. Current ratio for Walmart is 0.9, and for the target it's not given, not calculated. Okay, no problem. Both are Walmart risk ratios. Yeah. Okay. So they have not calculated based on the for both the companies. Target is excluded from here, but never mind. The formula will remain the same. You can calculate it. Okay, so when we are looking at the liquidity risks, there are always a few risks that we have to keep in mind. Is that the account receivable, because we are calculating current ratio on the account, including the account receivable. Account receivable may be slow to pay. It may not be even able to collect the money. If let's say there is a downfall in the market itself, suppliers are coming to ask the money from you, then I mean, and the supplier, your customer may not be able to pay you back as well. Inventory also, if does not sell, it can tie up the cash and liquidity problems, especially when the inventory is related with the fashion and which can go out of the fashion very soon or out of the trends very soon. So this may be a very high risk for the company. So normally the banks may get a audit of the account receivable and inventory to make sure that they are collectible. So there are special auditors appointed to check the value of receivables, value of inventories, whether they are properly valued, whether the stock is available to be sold, whether they are in the stock, the condition is good or anything. And then there are, if the company has a lot of short-term debt, it can also create long-term liquidity problem for the company because then the interest requirement and the principal repayments are very difficult. And then if we look at the supply list, let's say suppliers list, customer list, and if there's only one or two supplier which are or customers are coming on the top, which are majority of share, it may also impact the companies. So the risk is increased because the company's own survival depend on the efficiency of the supplier itself. If the supplier or the customer go bankrupt, the company will also face the difficulties, right? So this was the current ratio, quick ratio, cash ratio, and then there are some other ratios we have calculated already in the AI part is the debt to equity ratio, which tells us how much debt a company has accumulated. So the more debt company has accumulated compared to its own equity, the more risky it will be considered. So the ideal ratio is 2:1. Uh, you cannot you cannot borrow more than twice of the total number of equity that you have invested into your own company. So if the company has taken more than two, it's a problem, right? It's a problem for the company. It will be deemed as a risky unless they have a very high asset base. Another way of looking at the debt to equity and another way to look at the liquidity is interest coverage ratio. As I explained earlier, cash from operations divided by the interest that has to be paid plus the interest. If you're borrowing more money, how much extra is going to be there, so that has to be calculated. Ideally there is no industry benchmark to say okay what is the ideal number. It should have definitely has to be positive, means more than one, means your cash from operations should always be more than the interest paid. But how much more, like 5 times, 10 times, that depends on the industry and the comfort of the bank. Right. So that's the second part of the objective for analysis. Now let's look at the suppliers assessing the credit. Now there are different ways of looking at it. The information that we want, like for example, how much the company has already owned to its own supplier. So if it's a supplier who is assessing the company whether whether they can extend more credit to them or not, they want to know how much credit is already accumulated on that. So one way of looking at it, yes, we can look at the current ratio, right? But the current ratio is a very broad ratio because it includes short-term accruals, positions, everything, and the current ratio includes the payable, receivables of the overall company. Now, for the supplier to understand, to know whether the company has what other suppliers, they may not get the answer directly, right? So, because the company will not give that much of information to a single supplier, unless the supplier is really the biggest one and they want credit from that particular supplier, then they may give audited statements or based on the confidentiality. So, you can give that, you can do that as well. So you may want to look at how much the company already owe to its suppliers. What is their inventory turnover ratio to make sure that they have a good system to keep on selling the items, because supplier is interested in its own money and they will get the money only if the product is sold. So if the company is very slow to sell the product, then the supplier may not want to give a very high credit, because the risk is that the company may not be paying on time, or it may add the interest charges into the price or financing charges, right? So you can calculate inventory accounts payable turnover ratios. So you can ask AI to calculate the inventory turnover ratio and accounts payable turnover ratio. and it can calculate it for you. Right? So for Walmart, the inventory turnover ratio is 2.3, 2.2, 2.1, 2. So it's quite fast actually. Um, Calculate average holding is 2. So how much days it takes to sell the inventory? So the inventory days for the Walmart is about 155 days to hold the inventory, and to pay the suppliers it takes about 207 days. So it takes longer. Wow, it's quite a lot. I don't know if the number is correct or not, but let's assume it's correct for now, or we can calculate it ourselves. So let's calculate it ourselves. The way to calculate the inventory turnover ratio is daily. So inventory number of inventory turnover ratio is sales divided by inventory. So the inventory is here 56 10 times, and usually the turnover ratio we calculate 365 divided by turnover ratio. So it's 33 days. I don't know why the AI got 155 days. Quite strange number. Beginning inventory, ending inventory beginning inventory is not correct. But anyway, it got the wrong number, so I can't do much with that. So the average holding period for the inventory is about 33 days. So it sell its stock in within 30 days, and it's increasing. Right? So it's a concern for the company. Then the days payable outstanding. So at the moment, how many days payable outstanding it is? So you can calculate the same way, but here we don't calculate by the total sales. We calculate by cost of goods sold divide by the accounts payable ratio first. Accounts payable we can find here accounts payable, and then same way 365 divided by the turnover. So it takes about 42 days to pay a supplier, right? So now, if let's say the company is giving a 30-day credit and Walmart is paying in 40 days, then the company, the supplier will obviously negotiate with Walmart that, okay, you are paying, I will give you 45 days of credit, but I will increase the higher price. Or when they are supplying, they know that Walmart will take 45 days to pay. So they will adjust their credit policies accordingly if they want to sell. If they don't want to sell, they will they can refuse, or they can start to follow up earlier. So the strategies from the supplier can be aligned based on what are the objectives for the analysis, right? Again, so that's how we analyze the suppliers can use the financial statements analysis. So the three important turnover ratios for suppliers are days payable outstanding, inventory turnover, and total accounts payable, and turnover ratios. Right? For customers is going to be the other way around. For them, sales data is more important. How much sales have been done, which market, geography, segmentation, other segmentation, and the day sales outstanding. Now, the company may not give that information to a customer, whether how much money they owe to, how much money is total days outstanding in the market, because that may reflect very bad on the company. But let's look at the for the sake of calculation, let's look at that. The turnover ratio is 77, and when we calculate divide by 365, so they have outstanding. Walmart is a store. They are selling on credit, but just only take 5 days to realize their sales, and it is increasing in the past. Right? So uh, it means the most of their sales is not in the credit terms. But now we don't have that information of credit sales and actual sales. That's why we calculate based on total sales. Usually, you should calculate based on the credit sales only, right? So you can calculate the credit day sales outstanding. If the customer is able to get this data then they can negotiate again with the supplier. Let's say the Walmart is able to pay is paying now within 4 days only, right? So the supplier, then the customer will say, feel okay, fine. If I buy, I will get my money in 5 days, right? Or I have to pay in 5 days. Maybe it can help them to negotiate a longer term or a shorter term by giving them a cash discount. So if let's say it was 42, right? The company could negotiate, the customer could negotiate and say, hey, from others you are calculating it, you are collecting in 42 days. I will pay you in 30 days, but I need another 1% discount or 2% discount. Another information for customer is very important is the margin ratio. So you should never disclose your margin ratios to a customer, obviously, because then they will negotiate the prices with you, right? Okay. The last section of the financial statement analysis is internal management functions and ratio analysis. So ratio analysis, internal management functions, they want to look at the budget reports in the actual versus the budget, right? So, for example, in an example of the budget ratio, let me give you an example. So here's the sample profit and loss statement. Usually, a statement looks like this, right? So it's have many columns. Obviously, it's a sample number. These numbers are not real. It's just make up these numbers. I just make up these numbers for the purpose of this class only. There's one column for actual budget and then year to date actual and year to date last year. It's a very typical format for a management for any kind of company. They look at monthly profit and loss statement and compare against the budget for that particular department. So let's say this company is a rental company, for example, and then they have, let's say, three buildings A, B, C, and then they have maintenance expense for different companies, different buildings, and interest paying for different buildings, and utilities for different buildings. So we can either calculate a building by building profit and loss statement. The structure is not the same. If you want to know the profitability by building, then you need to structure it by building so that it's easy to do. Or if you want to structure it list like this, also can. Right. So let's say we want to do it. Now, simple ways, the variance is already calculated. So you just need to analyze whether the income has been more. Okay, fine. Check one, clear. Expense has been less. Okay, fine. Check clear. But you can look at individual expense. Is there any expense which is more than the budget? Let's say, for example, maintenance C. It's 72 pounds compared to 30 pounds of budget. Management of both of the A is more than the budget, right? The utilities were not budgeted for C, but we have to spend the money now. So you can ask the internal departments, why is that happening? So purpose of the management report is obviously to look at the manager of this company, manager of this particular department can pinpoint why the revenue is increase or decrease and what is the reason. You can also ask AI to do it for you. You can give it the copy this information and you can create a new chat and give this information to you. I'm going to give you my department P&L, generate insights for me to present to my GM. Okay, so I have given it. Let's see. See now it's you can get the cash report, right? You can get the inside report already for all the things. Of course, you have to read these in detail and make sure the fact check the information is correct or not correct. For the purpose of saving the time here, I will not read that into individual one by one. Otherwise, it will take a long time. So you can do that analysis. You can use the paid version as well to upload the file cache Excel file and then calculate it there. But at the moment, the AI is still not able to. There is no tool directly available to calculate within the Excel file. Those are coming up. Those tools will be coming up very soon. I think the Microsoft Copilot is going to be launched very soon. Plus, there are some Excel plugins being developed, which could help change the games. So we don't have to, read or calculate the formulas for by ourselves because AI can be do. But what we have to understand here is how we are going to interpret the data, interpret the results that are calculated by AI. So you have to get smarter in terms of foundational skills. That's what the purpose of this class is. So that's the important. But when we look at the variance analysis, we need to go deeper down into the details of why the variance is happening so that we can make a right decision. Okay. And in terms of liquidity, we calculate liquidity ratios, profitability ratios, debt ratios, and activity ratios that I have already explained in the past for a few sections. Activity ratios are inventory turnover, accounts receivable turnover, accounts payable turnover. Debt ratios are your current ratios, and the debt to equity ratio that we have already calculated all of them in the previous section. So I'm not going to repeat them now. The only thing is you have to find a benchmark for this. So since management is doing it, management might have a target set for themselves to be able to do the analysis for them. Right? So that's the important part of the analysis that you have to do. Right. So operational efficiency, as we have already calculated in the past, there are few key ratios that we can use for operating efficiency. Um, Sales turnover ratios, inventory turnover ratio. I have explained. Inventory turnover ratio usually tell us how fast we are able to sell our inventory. So the lower the number is better, but also it may means that we may be lower the number is better anyway. In any case, account receivable tells us how many days it takes to collect from the supplier. Here, the number may be lower or higher, but it's not a clear formula that if the number is lower is better. Yes, it's better for the company to collect the cash faster, but it may also create a obstacle for the company to compete against the competitors. If let's say the company is giving only a 5-10 day credit or a 15-day credit, while the other competitors are giving 1 month credit or 2 months credit, then it will put the company always at a disadvantage uh, to for a market condition where cash is scarce. So this may be the company may want to play out the credit policies to their advantage. Look at the competitor, how much they are allowing the customers to pay, and look at your own credit policy to make sure you're flexible enough to be competing in the market. Similar way, payables turnover, higher number of holding days indicates that the company is taking long time to pay, means preserving the cash, but it may not always be a positive thing because the supplier may not be happy getting paid later than we sell. If you calculate the Apple, so I think I have calculated that earlier. We used to calculate the Apple's turnover ratios, and what we found in Apple is that Apple's inventory holding days are 8 days, right? And the average collection days is 26 days. So the moment it purchase a Apple iPhone, right? It's able to realize the cash within 35 days, 8 days to sell, 26 days to collect. So total 35 days maximum. But it pays into the supplier in 105 days in total. So means that for 70 days it keeps the cash in its pocket, which is a counterproductive uh, can be a counterproductive strategy. Apple can carry that out because Apple is a huge company and it has a very high leverage on bargaining. But a small company may not be able to sustain this because the suppliers are always smart and clever. So if they find out that the company is trying to make a profit on their own pocket, they may not find it very healthy. So you may have to be careful in how you are interpreting the numbers. If it's more than the industry benchmark, you have to there are different repercussions. If it's lower than the industry benchmark, that means you are not able to take advantage of the credit facility, or you are maybe taking advantage of cash, so that cash discounts if it's available. So it can be a positive thing, can be a negative thing, depends on the circumstances, right? Then usually there is a cash efficiency ratio. I like to calculate how much money the company is holding in its hands, how much cash, how many days of cash it is. So it gives us an idea that, let's say the company is holding only 1 week of cash. So it applies specifically to the companies which we have where the cash is very less. So to tell us how many more days company can sustain without any extra income. So if it's like more a very high amount, it's good. For Apple, Samsung, they have cash surplus, cash reserves to sustain like 6 months of their usual expenses. So even if they don't earn anything, they can have the same level of business as they are doing for another 6 months. They have that much of cash in their hands. For a company like Lenovo or company like Xiaomi, they don't have that much of cash in their hands. Their cash is limited to only 7 days or 8 days or maybe 10 days of supplies. That's it. After that, they will go bankrupt. So that's the important part of the thing that you have to analyze. So here it's important to understand the industry standards. There are always seasonality and cyclicality of the business. Like for example, COVID has disturbed the cyclicality of the business. Seasonality is the same, but cyclicality is different. Quality of information makes the difference, and also an integrated approach. Okay, so apart from these ratios, the management also try to understand the operational analysis using sales. So sales analysis are usually done through the sales ratios, where we try to understand the effectiveness of sales, sales by person, sales by segment, sales by customer, sales by geography, sales by product, sales by different type of segmentation that we have to do. So management reports usually are fill up with all that information by customer type, product, region, room types, every information which can help the management to understand the sales in much more deeper details. And there are turnover ratios that we have already calculated. Total sales turnover by number of sets, sales per employee, sales per machine, sales in from total resources. So that's again helps to measure the efficiency of utilizing our resources to generate the sales. But you have to compare it against your previous year. Usually, there are no industry benchmarks because every company has different business model, different way of selling, different unique strengths. So, industry benchmark may not help in sales turnover. Then conversion acquisition to convenience conversion ratio. So you can look at the marketing and sales efforts by looking at ads, advertisements, social media marketing, websites, conversion ratios. So those kind of things can help to understand how much customers company is attracting, how much company has been paying, how converting it to the sales, actual sales, and what is the effectiveness of those who are converted, how much they are paying to the company, and whether the company is able to retain them for a long period of time or not. Okay. Then cost of sales. We look at operating margin, inventory turnover ratios, and inventory holding days. I have explained that earlier as well already. Then sorry, collection from the payments usually is simple calculation. Working capital ratio, which we have already calculated. Okay, so let's take a another 5 minutes break, and then we will wrap up the class after that break. Is everybody back? Okay, let's start the class again. Okay, so the other, as I discussed in the beginning of the class, There are other tools apart from the vertical analysis, horizontal analysis, and the ratio analysis. There are some other ways of understanding the financial statements, or carrying out the financial analysis to understand a very critical information about the company, and that is called linking of financial statements, right? So what is linking of financial statements? Every every the info every financial statements usually are linked in different ways. So for example, like sales and receivables data, so how the sales and receivables are connected together. You see, when you normally sell a data, when you normally sell a product, either you collect the money in cash or you collect the money in credit, right? So if you collect the money in cash, then it's fine. You don't have any sales receivables. But in practical terms, a certain percentage amount of the company's total sales is in the credit, unless the company has been selling everything prepaid or everything in cash down, right? So it means then will not have a sales receivable. But if the company is selling a receivable, usually with the increase in sales, even though the absolute number of the receivables will increase, but the days outstanding, the sales outstanding number of days, the sales outstanding will should not increase that significantly. So if the sales has increased and the day sales outstanding has also increased significantly, it may mean that either the sales is fake, or there are risky customers involved in the process because they may not be paying the money on time. So if you see that a high a day, with the increase in the sales, the sales day sales outstanding is increased, or the sales number of outstanding days to collect the supplier collect from the customers have increased, it may indicate a problem with their collection system and the credit worthiness of the customers. So that again helps the lenders or the banks to establish whether the sales is truth, the turnover is truth or not. The board of directors or the CEOs or the stakeholders can also understand whether the sales is true, or whether the asset receivable, account receivable that are shown in the balance sheet are true number or not, whether the assets are overstated or not, right? Uh, then you can look at the similar way, you can look at the cost of goods sold and inventory holding days. If the cost of goods sold had increased and inventory holding days also increased, that may also mean the same thing, right? That the inventory is not the correct one or is a fake one. So, for example, the inventory turnover ratio, if a low inventory turnover means there is an excess inventory or there is an ineffective inventory management. The days outstanding is a high day outstanding will indicate either a slow moving inventory or a fake inventory. Either way. And also the inventory valuation can be affected by the method that you choose. So let's say if you're using last in first out, or you're changing the accounting valuation method every year, every 2 years, that may indicate there are problems with the financial statement. So uh, these kind of information, if we know already, or we keep in mind, then we can understand the tricks of manipulating the financial statements. Then we look similar way, we look at cost of goods sold and inventory suppliers. So in the cost of goods sold has increased and inventory supplier also increased, it may mean that we have a problem. Either we are not paying them on time deliberately, or there may be fake, right? Uh, Payable ratio. And then there are selling general and administrative expenses to total raise. So these are normally the wages are fixed normally, right? But if the wage ratio has increased, or the wages has increased similar to the sales, then usually it means that either the company is not able to manage their labor cost properly, or um, or a workforce, a company has hired more high paying salary compared to the business increase, right? A low salary cost, on the other hand, may mean that the workforce is not a quality workforce left in the company, because high quality workforce usually demand higher salaries. Similar way, you can look at other things like interest paid, and interest financial debt ratio. Means if the interest coverage ratio is a problem, then the company may not get a good debt. And if the debt equity ratio is too high, that may also indicate a problem with the high financial risk. And the debt, uh, if the debt has increased and interest has also and the interest has not increased, it may mean that the company may be getting the data, maybe getting the debt on a, or the interest has increased more than compared to the total increase in the debt, means the company may be borrowing at a very high rate. Usually the banks or the suppliers will calculate the average interest rate paid by the company, total interest cost divided by the outstanding debt. So that will help the company to understand whether they are getting the money in line with the industry standards, or they are getting a higher cost, or they are paying a higher cost. Depreciation usually is a very big method to scam on the company's financial resources, or the scam on manipulating the profit and loss for taxation purposes, or for earning reporting a higher net income. Okay, so let's now recap on the so now we have looked at the financial statement analysis, we looked at the framework, we looked at the four use cases of financial statements. So the framework was to understand the objective, collect the data, and then analyze the data, validate the results, and communicate it. We covered the first three parts. We can look at the objectives. Objective was to invest, assess the credit worthiness by suppliers or credit customers, and also by management for their own internal purposes. Right. So we collect the data. We looked at what kind of data we need, what kind of tools we need. I show you some examples of calculating for investment purposes, for management purposes, and also showcase you some of the AI tools, but not some, maybe only one AI use toolkit to use, how we can use that for analysis. There are other tools available like chatpdf.com or other tools where you can analyze the financial data of listed companies, and can get the generative AI to help you with that. So generative AI can help you with writing reports, right? So let's say you have a data, and like for example, I show you earlier here, you can write a report. Now the only problem with this is that you will have to read the report in detail. They can ChatGPT can create a report for you based on its own understanding, and it can be very detailed. So you can customize the prompt and say, give me a report in 100 words, give me a report in 200 words or 1000 words. It can do. If you give it long, then the actual substance is finished in, let's say, 100 words. The rest of 900 words, it will just keep on doing something or keep on repeating the same thing again and again in different words. If you ask it to summarize it, it may leave certain information. Let's say if the actual analysis is 500 words and you ask it to summarize in 200, then it may have to deduct the 300, right? So it may make its own decision to discard the necessary information, which is maybe a necessary information for the user. So you have to very smart in giving the prompts, right prompts, so that you can use this information. AI can help you search the information. I show you the use case of Bing, where you can give it a command like this. and we can calculate the information. So even we don't have to go anywhere on the website to. I downloaded the profit and loss statement. I calculated them myself. But the other alternative result is I could have gone into the PDF into the Bing and get all the information here with the links available to the sources. So if I want to verify the source, I can just click on the link and then I will reach to the source where the information is shown. So that is a good power of AI. AI can also calculate the variances. So as I show you earlier, the 3.5, free version can calculate even though the text window of the copy paste data is pretty small. It's only I think about 4,000 words that maximum you can type paste into this. More than that, 4,000 characters, it's going to deny or going to ask you to shorten the data. But there are some free tools available which can accept up to 100,000 words as well, like Cloud Instant, which is available for free to use on different platforms. So you can go to huggingface.com and then can use it for free. So you can search where I can use this Cloud and then you can use it. Nama is available. I think they also have a very high token list, around 32,000 words. If you are subscribing to the plus version of GPT, you may get a 16,000 word limit. But again, the limitation is there. AI can also create templates and standardize the reporting. So, if you have already templates that can use the template to standardize. If it's not, it can create a template for you and it can use that template for reporting purpose to remove the errors. And then also it can create visualization. So we have not created visualizations here, but we can create a visualization. So we can ask uh, the free version of the ChatGPT 3.5 cannot generate visualizations. So we have to use the GPT-4 version for this, and we can copy the data. Some of the data we can copy, and then we can ask GPT-4 to analyze the information. Let's say we take only the sales information for now, and then we can calculate it. GPT-4 code interpreter, we can say create a visualization for this. So usually it can easily create because the data is very small, right? um, Even though now I have just copy paste the simple text, we could actually calculate the growth rates of sales, or we could ask the AI to calculate the growth rate of sales, and then show it in the visualization, show it into the charts. We could have calculated the cost of goods sold as a percentage to sales, and then show it in the growth charts. The AI will not do it automatically. We have to tell AI what we exactly want. If we don't tell anything, it will assume whatever it assumes, and then it will generate the results based on that assumption. So, for example, here it has calculated a bar chart of all on the same, right? Now, do we want everything on the same? Maybe not. So that's why it has now calculated all on the same. So we could ask it, can I get only sales growth rates in the form of line chart, color, So it may be able to create that. Let's see if it's able to create that graphics for us. Yeah, so it can create it and it's blue color, right? Now we can calculate COGS to sales percentage over years and show pattern. Please also calculate and display forecast for next 2 years. Uh, in a simple way, it can calculate that as well. So to use these graphs, you just have to copy and paste. But these are not very good with the terms of design or with the terms of display. So you have to edit them or you have to use as it is, just like this. So now you can see it was 75%, now 74, 75, 75, 74, 75. So the forecast for the next 2 years is 75.23% based on the last year's comparative information. So that's how it is calculated. So you can use AI for calculating different purposes and visualize the information. So you have to the visualization principle simply means that you have to understand your story and then you have to tell that story through the colors, visualization, impacts, emphasize, bold, templates, headlines. There are all important part of visualization. So that's a completely different class, a topic for a different subject. Okay. Okay. So now we are open for the floor question and answer. So if you would like, please you can ask your question and answers now. Okay, so thank you, Elizabeth, for asking whether the how reliable is our AI generated results. Do you suggest always double checking? Um, at the moment, in terms of calculations only, yes, AI generated results are reliable, but it's I suggest you have to do a spot check to make sure it's taking the right number, right reference. So let's say when I try to calculate from the Excel file in the class, it was not able to understand the correct opening number of the inventory and closing number of the inventory. So it calculated a wrong formula for us, right? But when we calculate Excel in Excel by ourselves, we calculate it in a different way. So the AI is, if it knows correct information, it will give you the correct answer as well. But in arithmetically, it's correct. You can rely on that. But the problem is that it may not understand the context and get the right data all the time. So you always have to have a double check to make sure that the number is calculated. But as regards as you make sure that the reference is correct. You don't have to actually always check the accuracy of their calculations. That is quite accurate. So if you can do a spot check, definitely if you want, no problem with that. Another thing I would ask you is, I mean, I use the Chat GPT for, let's say, Walmart. The information is publicly available, so I don't have a problem with that. But I would not do that for my own company data. So that is quite risky in terms of confidentiality of the information. So if it's a very sensitive information, I would not suggest you share onto the chat GPT without normalizing the data. So there are free tools available on the web which can help you to normalize the data and remove the sensitive parts of information from it. So please always do that. Change the name of company, change the years, at least to protect the, the, the data sensitivity. I hope that answers your question. The biggest benefit of using the AI for financial statements is going to be reduce your time on research. So, for example, like I show you on the bank, right? You can ask ChatGPT to AI to collect the information, not only the financial information, but also the non-financial information, market research, and other sorts of trending data, which can be used for analysis part. And you can get it all within a very short period of time. That's the only benefit at this point of time to use the financial statements for AI in analytical parts, right? Uh, but you still have to do the analysis. You still have to use your own skills to be able to do the analysis. The data collection is very good with AI. Analytical part is good as well, but it's a very standard and very weak analysis. It cannot assume all the scenarios. So you have to do that analysis part for it. Write down the bullet summaries or the key insights from the data, and then you ask it to create a report based on those insights. Then it will be able to give you a more powerful report compared to what it can do by itself. So if you guide it, yes, it can. It's very strong and very powerful. If you just let it do what it want to do, it's not really worth of spending the time. Does that answer your question? Thank you. If there's any other question, please feel free to ask. Otherwise, Alex, you can pull up the feedback survey forms.